Hello, thank you so much for purchasing this course. This is going to be a crash course on the stock market options. So definitely let me know how it goes. I'll try to add and edit things as we go along. So the first topic is, what is the stock market? So what I want you to do is, we'll think of the stock market. There's going to be three components. So we're going to say those are three stores. So for example, the first one will be Target, which is the Dow Jones. And so you might hear a lot of stuff on the news about the Dow Jones up 1,000 points. So this is what it is. The Dow Jones is made up of 30 companies, usually top companies like Apple, Microsoft, for example. And then you have Walmart, which is going to represent the S&P 500. And so this one is made up of 500 companies, and it's from all indices. It could be pharmaceutical, technology, could even be some from overseas, but majority of them are American companies. And then we have Costco, which is the NASDAQ. And so NASDAQ is comprised of all technology companies. So again, Apple, Amazon, Microsoft. And so now you're going to think of your house as the broker. And so a broker is examples like TD Ameritrade, E-Trade, Webull, Robinhood. All of these are trusted brokers. Robinhood, not so much, just because they don't really have a live customer service. So if there's any issues, usually Robinhood, there's been some problems with Robinhood, but usually TD Ameritrade, E-Trade, Webull, Tastyworks, these are all great brokers to use. And so when you're going into these stores, you're going to see some similarity of items in between Target, Walmart, and Costco. And so, for example, like maybe TVs or cash registers. And so the cash register in this example could be Apple. So Apple is in the Dow Jones, it's in the S&P 500, and it's also in the NASDAQ. And so not all of these items in each store are created equal. And so that means that some items have more weight than others. So for example, the cash register in this example plays a pivotal role in these stores, because if you took some of these cash registers out, it's either going to decrease the flow, so people are going to get more backed up, so it's not going to work as efficiently. And so it's the same thing if Apple starts going down, or if there's bad news, the stock's going to start going down. And so what's going to happen is actually going to take the market with it. So the market's going to end up going down, just because Apple has so much more weight in these indices in the Dow Jones, S&P, and NASDAQ. So if Apple's down, then overall the market might be down. And just because of the market cap, it just has a lot of money and a lot of people trading in and out of these stocks. So what you can do is you could go shopping in any of these stores. And so what you can do is you could purchase some of these items. So if you see a fridge or a bed or something you like, you could purchase it, take it back to your house, which again is the broker, and you're going to start off with nothing, right? So you're going to open up the account. There's going to be no stocks in there. So while you're shopping around, you're purchasing pieces of stock. So that's what these items are. They're part of the stock. So let's take an example. So say you're gonna buy a bed, and the bed's gonna represent Microsoft in this example. So you buy this bed from Costco, and again, Costco is the NASDAQ. So you pay $300 and you bring it into your home. Again, your home is the broker in this case. So as soon as you go home, you hear some positive news that came out about the bed, how great it is for low back pain. You could sleep through the night. So people are raving about this bed. And so this translates into positive news. So maybe some positive news about Microsoft came out, about a new computer, or just positive news about their event. Maybe they're coming out with a new phone. And so this drives up the price. And so now there's more demand for this bed or Microsoft. And so what happens is, now a few days later, your bed is now worth $350. So you're super excited, you're ready, you're gonna go back to Costco, and you're gonna sell them your bed, because the demand is so high that they actually, Costco's going to pay you $350. So you just made a $50 profit on this deal. Now you're very happy, you're super excited, and what you're gonna do is you want to reinvest your profits, and you see a new TV. So in this case, the TV, let's say it's gonna represent Amazon. So Amazon, you're gonna buy this TV for $350. So again, Amazon is trading roughly around, say, $3,000 a share right now at this time of recording. And so even though you're paying $350, you're not gonna have 100 shares. So you're gonna own a piece of Amazon. And so what you're gonna do is you take the TV home, you're super excited, and now you set up your TV and you turn on your TV, and right in the middle of the screen is a black ball, and now your TV is broken. So it's the same thing, some bad news about Amazon, maybe about Amazon Prime raising their prices. So some bad news is going to start driving the price of Amazon down. And so now, since you have this TV and it's broken, and you're not the only one that has this TV, maybe say thousands of people purchased this TV from Costco, and now Costco has to recall some of these TVs, and so now the new price of this TV is $250 because people heard that most of these TVs are broken. So you start panicking, and you want to go back to Costco and sell them the TV before any other parts break down and you lose even more money. So you go back to Costco, you sell them the TV, they buy it back for $250. So now you're actually at $100 loss. If you include everything, but if you just maybe include the profit, you're down $50 because initially you started off with that $300 in the previous example. But let's just say you're down $100 because you're up 350 and now you're down 250. And so the price of the TV is going to continue going down because now all of these people are going to go back to Costco and start selling their TVs back. So now Costco has this surplus of extra TVs that they can't really get rid of because of all this bad news. So now this is actually going to start driving the price of Amazon down further, just because there's no demand for these stocks. So it's all demand and supply and demand. And so what's going to happen is the price is going to keep going down, and they might have to put these TVs on clearance or come up with some new. So the price is going to stay around the same or continue going down until there's some positive news that comes out about the TV saying that it was actually one of the parts was actually missing or something, and you're going to get a new TV. And so the price of this positive news is going to start driving the Amazon price and the TV price back up. And so what's going to happen is now there's going to be more demand for these TVs. So then people are going to go back to Costco, start buying the TVs, and then Costco is going to start selling the TVs, and they might sell out of these TVs because it's such a good price. And that's going to be the same thing. So now more people are buying into Amazon, and it's going to drive Amazon price up. And so it's the same thing, especially when you're buying some shares. When you buy a piece of, like when you buy the bed or the TV, for example, and what happens is you're never going to buy all of the beds. So you're never going to own all of like Microsoft or Apple. You're just going to own a piece of Apple, Microsoft, Amazon, for example. And because Costco could always get more beds in this case, and then they just always have some supply. So it's the same thing. You'll own part of, you'll be a shareholder. So that's what that means of these stocks. So hopefully this made some sense. And just let me know again how it's going, and we will continue breaking this down. So we will see you next time. Thanks.